Thank you, Web Summit, for the warm welcome. My name is Emily Zheng, and I'm a senior VC research analyst at PitchBook. Today, I'll be discussing key venture capital trends in North America, spanning topics like exits, secondaries, deal-making, and fundraising. If I only had one word to describe the current state of VC, it would be bifurcation. We're seeing a clear market split between the haves and the have-nots. A few headline deals and exits are carrying the quarter, while activity beneath the surface remains subdued. AI startups have been dominating both headlines and venture dollars, capturing over 60% of deal value with only about a third of deal count. But beyond those bright spots, the market remains stuck in a stalemate due to seemingly never-ending headwinds. There are signs of life, but we're still in a constrained, highly selective environment. Coming into 2025, there was real optimism that we'd see a rebound in VC liquidity. The IPO pipeline looked promising with filings from startups like crypto firm Gemini and defense and space tech company Voyager, both of which are well-positioned to benefit from the Trump administration's key policy themes like crypto and American dynamism. But instead, tariff uncertainty has caused some startups that have already filed to delay going public. Q1's exit value of $54 billion is the highest quarterly value since Q1 of 2022, but is heavily concentrated. In fact, only 13 companies went public this quarter, with CoreWeave being the lone unicorn. CoreWeave went public about a week before the tariff announcements and single-handedly generated nearly a third of Q1's exit value. Its share price has more than doubled since going public in late March, but after it had an initial valuation cut and multiple consecutive days of double-digit market swings, both positive and negative in the first week and a half of its trading. Though the initial shock from Liberation Day has started to wear off, and companies like Hinge and Mountain have gone public this May, uncertainty will continue until some major policy questions are answered. This likely means that IPOs will not be making a comeback in 2025 like many hoped. This is tough news. The venture exit environment has been reminiscent of Goldilocks over the past 5 years. Too hot during the zero interest rate policy era, too cold since interest rates first hiked in 2022, and as startups are finding this just right market, hopefully they haven't already missed their IPO window. At best, we may see a modest uptick in the last quarter of this year. We're not expecting full rebound until 2026 at the very earliest. Now, who here has heard about secondaries? Yeah, a good number of you. Secondaries are a really hot topic, but it's opaque in many ways than one. Secondaries are really stepping out to help ease VC's liquidity crunch, but only for the privileged few. This bifurcation and split between the haves and have-nots is even more pronounced in the secondary market. In Q1, secondary pricing swung in favor of sellers, with average and median discounts flipping to premiums of 6% and 3% respectively. However, this value is inflated because secondary transactions have been disproportionately concentrated among the top startups that have the highest valuations and the highest investor demand. So a large proportion of secondary buyers are only looking at the top 10, maybe top 20 of the most valuable unicorns. So medians are high only because most startups aren't even represented in this data. Most sellers are unable to close secondary transactions even at steep discounts. Access to the secondary market is therefore really limited due to this market concentration. Based on activity over the last 12 months, we estimate that the direct VC secondary market size to be $60 billion. This is a notable increase from our 2024 estimate of $50 billion, but before we start claiming that secondaries are the new IPOs and IPOs are extinct, we need to remember that a lot of this value is driven by ballooning unicorn valuations. So overall, secondaries remain a relatively small slice of the broader venture landscape. For context, it makes up less than 2% of total unicorn value and about a third of primary VC exit value when we're looking at that $60 billion figure. So yes, the secondary market does provide valuable liquidity to the asset class, but only if you're one of the few privileged investors and employees that have a stake in these elite, most valuable, and most prominent startups. But secondaries do have strong potential for growth. An important trend to keep an eye on is the positive correlation between the primary and VC secondary markets. I like to say that secondaries echo primary VC with a lag of about 1 to 2 quarters. What does this mean for the future of venture? Well, when this rebound eventually happens and there's greater primary deal making and primary exit activity, this will mean that there will be more comparable data points and therefore greater pricing transparency. Buyers will be more incentivized to look at startups outside of the select few, and with more startups trading on the secondary market, there is so much more room to grow. Dry powder figures for venture secondary funds have more than doubled since 2022. It totals nearly $10 billion as of September 2024, though in context, this is still only about 3% of the total dry powder that's allocated to primary VC. Much of this growth is fueled by new venture investors, like family offices and pensions, who view secondaries as a more accessible entry point to the asset class. Secondaries, after all, require lower minimums and shorter investment timelines, and are often late-stage startups that already have a proven business model and a viable path to exit already. So yeah, buyers get far less upside, but also far less risk. So now let's pivot and take a closer look at deal making. Just 10 transactions accounted for 60% of all investment this quarter, and OpenAI made up a huge portion of that. Even excluding OpenAI's eye-watering $40 billion deal, the other top 9 deals made up about a quarter of all VC capital deployed. So what stands out is that quarterly deal value was $110 billion, which is an all-time high that surpasses even pandemic-era deal-making figures. But despite this high number, VC still hasn't made a rebound. So what's the discrepancy here? Deal value was largely driven by a few huge AI rounds. As I mentioned earlier, OpenAI raised a $40 billion round, Anthropic raised 2 rounds totaling $4.5 billion, Infinite Reality brought in $3 billion, and Grok raised $1.5 billion. So AI is the clear exception to what's otherwise a cautious market. Outside of AI, investors are selective with a lower risk appetite and stronger preference for quality. So let's really dive deeper into the data to highlight what the venture market is really like for most of venture. For example, we're seeing a higher concentration of larger deals and lower concentration of smaller deals. Over 83% of deals were over $50 million in Q1, which is the highest concentration in over a decade, which is just another example of how investors are prioritizing quality. Newer companies are facing the brunt of this deal-making stalemate. First-time financings have slowed down as LPs and GPs are just less willing to take risks on new startups. In Q1, less than $6 billion was invested across 1,000 deals. Flat and down rounds are also becoming increasingly more common, making up a quarter of Q1 deals, which is a decade high. Many startups locked in high valuations during the pandemic era in what I call golden handcuffs. These elevated prices have prevented startups from moving forward because many investors are unwilling to pay these pandemic premiums. Now that venture slowdown has extended into its 3rd year, more startups are finally coming back into the market as they reach the end of their cash runway. In order to raise more capital in today's tough environment, startups need to adjust their valuations to better reflect their business fundamentals. So when we're looking at top-line valuation figures, they may seem high, but valuation growth is not. As you can see in this chart here that looks at Series D and later startups, growth between rounds have fallen off a cliff since 2021. Back in 2021, over half of Series D and later startups were doubling their valuations on an annualized basis in between rounds. But now that growth is about 10%. Despite their increasing commonality, down rounds still have a stigma attached to them. So venture debt is becoming increasingly common, as you can see in the second to the right bar. Venture debt is not necessarily a substitute for equity rounds, but it can help startups avoid or at least delay the stigma of a down round. Venture debt dollars skyrocketed in 2024, crossing $62 billion, driven by fewer but larger deals. Overall, deal-making activity is very concentrated. Quality companies, especially in hot sectors like AI, are still getting funded. Everyone else is facing longer timelines and tougher terms. Again, this bifurcation theme. Fundraising continues to be the most constrained part of the venture ecosystem. Only $10 billion was raised across 100 funds in Q1. And if this pace continues, 2025 is on track to be the weakest year for VC fundraising in over a decade. And a big reason for the sluggish pace is liquidity or the lack thereof. LPs just haven't been seeing meaningful distributions in years, and that has made them even more cautious. Those that are still allocating capital prefer large, established managers with strong historical returns. For existing dry powder, managers are taking their time with deploying capital, often waiting for more favorable deal terms or clearer exit paths. Over half of US dry powder is now between 3 and 5 years old, which is a sign of just how long firms are stretching out their investment timelines. Performance is playing a bigger role in LP decisions than ever. Managers that have raised a new fund since 2021 are consistently outperforming firms that have not, which is yet another example of this broadening gap between the top managers and other venture investors, the haves and the have-nots. The dominance of established funds will likely continue until there is a greater and more consistent flow of dollars. LPs need to first recoup their deficit between capital calls and distributions before committing to new investments. So despite venture's continued sluggish pace, there is a strong case for optimism in the near future, believe it or not. Being a North American investor in startup has its advantages, as evidenced by our ecosystem scores. This is a proprietary system that PitchBook uses to assess the size, maturity, and growth rates of venture ecosystems around the globe. In terms of overall score, 5 US cities lead the pack, including SF, New York, Boston, Los Angeles, and Seattle. In terms of development score, which highlights known hotspots, the US leads with Canada in 7th. And 5 North American cities made the top 20 locations by growth, including Ottawa, Calgary, Sacramento, Indianapolis, and Miami. Overall, we expect policy developments, especially around tariffs, to play a central role in shaping venture sentiment. Until more clarity arises, political volatility and market swings will keep recovery and liquidity just out of reach. This is a tough pill to swallow for the asset class, which has been stuck in a stalemate since 2022 and desperately needs exits and a greater flow of capital, since over $3 trillion is locked up in unicorns. Many of venture's highest value companies are often too big to be acquired or have very few potential acquirers, so the IPO market really needs to reopen. But there's still reason to believe that if macro conditions stabilize, we could see the beginning of a recovery by the end of 2025. After all, multiple notable startups have already filed and are just waiting for the market to calm down. Hopefully, their exits will be the much-needed catalyst that venture needs to spur more activity. Thank you so much for joining me today, Web Summit. That concludes my presentation. My contact information and the slides I used today will be available via this QR code. Thank you again, and have a great rest of your day.